Hey, this is Wayne Wagner from Visionary Wealth Management, and I wanted to speak for a couple of minutes with you about the recent volatility we're seeing in the stock market and, frankly, what we're expecting for 2022, which is probably not outsized to the upside stock market performance. Here's the fact of the matter. The fact of the matter is the stock market is trading at very high PE, or price to earnings ratio. So you're paying a lot of money today for every dollar of earnings coming out of, let's say, S&P 500 companies. And one of two things has to happen for that PE ratio to come back down into kind of a historically normal range. One is stocks can come down, stock prices can come down. The other is earnings of companies can come up, because if it's price to earnings, the earnings denominator, the higher that gets, the lower the price to earnings ratio is, mathematically speaking. So we need some combination of ongoing increased earnings and kind of fluctuation. We could get sideways, we could get down performance out of the stock market. Now, here's what we don't see. I want you to think about the last 3 times really that the stock market has pulled back by, let's say, 35% or more. That's going to be first quarter of 2020 when the pandemic hit, right? It's going to be 2008 during the housing crisis, and it's going to be 2000 to 2002 when we were coming off of the internet bubble and then got hit with 9/11 and the start of the war on terror. But so the last 3 times we had some kind of really systemic hit that caused a 35, 40, 50, in the case of 2008, it was a 60% plus drop in stock prices. There was something really fundamentally, systemically wrong with the market. In the late 90s, you had the overblown valuations associated with the tech market and the run up to Y2K, which really, if you think about it historically speaking, we spent like 10 years worth of technology budget in the last 2 years because everybody was afraid their computers were going to stop working. And then suddenly in 2000, nobody had any tech budget and all the tech companies crashed because nobody was buying their products, right? And that was because we spent all the money in 99. Come up to 2007, 2008, the market peaks out, starts to drop in October 2007. It's down 40% in 2008, continues to fall through March of 2009. So it was an 18-month run there, 60% plus top to bottom. But that was all predicated on the debt bomb, the mortgage debt crisis, right? And all of the over leverage and overbuying and no documentation loans and interest only loans and all of the other kinds of mortgages. I don't know if you've gotten a mortgage lately, but they're not doing no doc loans anymore, and they're not doing a lot of adjustable rate mortgages or balloons mortgages. If they're doing that, they're doing it for 7, 10, 15 years out. And then, we're getting through this pandemic, and even if we get a couple of more variants or things like that, we're probably not going to repeat the same kind of fear, kind of shock and awe in the markets the next time. So we really don't see a reason for some kind of a dramatic 30, 40, 50% pullback. But as I've said before, we do have some dry powder. We are positioned a bit conservatively in anticipation of maybe a 10 to 20, maybe 25% pullback. And that would be in coordination with what we think will be continuing to rise gradually earnings, but really trying to get the PE ratio, the price to earnings ratio of the market back into kind of a normalized range, because right now it's kind of above the high end of the normalized range. So I hope that's helpful for you here at Visionary Wealth Management. We're always here with perspective for the decisions ahead. And when you see me or talk to me next, ask me about this route behind me. This is in my home office. I hope you're doing great. Have a wonderful day, have a wonderful week, and I hope everybody stayed safe through this nor'easter that came through. Take care.